Okay, so we understand like how the loan works, we understand how like the interest rates work, we understand about how much that's going to mean that you pay in total for your house. And now we should be looking at, okay, what are the different types of mortgages that you can get? So we just talked about interest only versus interest plus repayment mortgages. And then the other things you need to know are the way that banks apply interest rates. So you may have heard of fixed rate mortgages. And what that means is that the bank will set an interest rate at a fixed amount. So it might be, so say you had a 3.5% fixed rate mortgage, then that means that for the term of the fixed rate, which could be 2 years, 3 years, 5 years, you're going to be definitely paying 3.5%. That won't change. So it's fixed in, and you know that that won't change for that time period. And the banks will only fix for a certain number of years because they don't know what's going to happen with the world. So it's quite rare to find fixes longer than, say, 7-10 years because the banks are aware that they don't want to get locked in on a rate where they don't make any money, basically. So when you see a fixed rate mortgage, that gives you certainty about the amount that you're going to be paying back every month for that time period of 2, 3, 5 years, right? You are locked in at that rate. That can be great if you are the type of person that really likes certainty, right? You'd want to know that every single month you're going to be paying back exactly the same amount. You're not going to have to try and find some additional money. You've got that 100% certainty that you can do that. The downside of fixed rates is that you could at times end up paying more than the market rate, right? As interest rates generally in the world go up and down, you could find that you are paying a bit more than somebody else on a variable or tracker rate. And I'll explain what those are. Okay, then the other main type of mortgage that you often see is a tracker rate mortgage. So unlike fixed mortgages where everything is fixed and set, trackers move, right? They're variable. They can go up and down. The rate that applies goes up and down. And what they do is the banks will look at whatever the base rate of the Bank of England. So Bank of England sets a standard interest rate, which kind of acts like the floor for all interest rates. And then the banks look at that and they say, right, we are going to set our tracker interest rate at a number of percentage points above the base rate. So say the base rate was 0.5%, the Bank of England base rate, 0.5%. The banks might say, okay, we're going to set our tracker rate at 2% above the Bank of England base rate. So you would be paying 2.5% interest because that 2% on top of that 0.5%, and that would give you your tracker rate. Now, tracker rates can often be a little bit cheaper than fixed rates, but only where the Bank of England base rate stays really low. So we have had since the last financial crisis, we've had incredibly low Bank of England base rates, like the lowest ever in our history. And so that has meant that tracker rates have actually been quite a good deal for a lot of people because they've been very, very low. The risk with trackers is that if the Bank of England rate goes up, then the tracker rates go up and you have no way of really knowing what's going to happen. So pros and cons of each. Fixed gives you certainty, but you could be paying a bit more. Trackers, if Bank of England rates are very low, then you will pay less, but you could have the risk that in the future it goes up and then you suddenly find that you're paying a lot more for your mortgage than you expected. Then the final type is what's known as the lender's standard variable rate. And this tends to be a rate that you get put onto when whatever your mortgage deal ends. So maybe you've been on a 3-year fixed or a 3-year tracker. At the end of that time period, the bank will flip you onto their standard variable rate. And the standard variable rate is just a rate that they set that goes up and down in according to like economic conditions. And it tends to not be very good, right? It tends to be a lot less of a good deal than one that you negotiate at the beginning. So generally what happens is you will get into your 3-year fixed or your 3-year tracker, and then at the end of that 3 years you would be looking to get either a new mortgage with a different bank or building society, or effectively like renegotiate your loan with your existing bank, because standard variable rate tends to be more expensive. Okay, so we've talked now about how mortgages work, some of the jargon. Now we're going to go into how do you actually get one, and what should you be looking for, and how do you prepare? So when it comes to finding a mortgage, we always recommend working with a mortgage broker, because they are experts who look at all of the mortgage market that's available to brokers, and then they look at your situation and they work out what is the best deal for you and then give you some options. So when you're looking at working with a mortgage broker, you want to make sure that you're working with one that covers what's known as whole of market. And that is because then you know that they are looking at all of the deals that are available through brokers. And so they will not just be looking at like a few deals, they'll be looking at everything that's available through them. And then they'll be able to make recommendations based on a wide range of mortgages and mortgage providers. So whole of market is what you're looking for. Now be aware that some banks and building societies don't work with brokers. So even though we say always go with a broker, if you are not sure or you think there might be a better deal out there, you can always look on one of the price comparison sites and just double check the deal that you're being offered through the broker to see whether there could be a deal that a bank offers you directly and that you can apply for directly that could be better. So the scenario is really go with a mortgage broker, get some recommendations, try to understand how much you can borrow, how much interest you're going to be paying, what your monthly repayments are, and then double check that through a price comparison site to see what else might be available that the brokers don't have access to. So how do you choose a good broker? Well, we have recommendations on our site of ones which are well known, get great Trustpilot reviews, and are whole of market. And it's great to work with a broker because you shouldn't be paying them up front. They get paid by the bank or the building society. So it doesn't cost you anything, but you get the benefit of their expertise, and they will kind of do a lot of the work for you. They'll help you with the paperwork. It just takes a lot of the hassle and stress around trying to figure it out yourself. And like I say, there's no commitment to using them. If you find a better deal elsewhere on your own, great. But definitely think about working with a mortgage broker. And then what does the process look like? Right, well, the mortgage broker is going to ask you a lot of questions about how much you earn. They're going to want to know like how much you spend, like what are your expenses every month, what debt you have, you know, what you're currently spending your money on. And that's because when the banks look at lending you money, they're looking at a couple of things. They're looking at, can you afford it now? Do you have like that amount of deposit? Do you have enough salary coming in every month? And are you spending too much money on other things? Because they want to make sure that you can easily afford your mortgage repayments. And they're also going to kind of stress test it. So they're going to look at, okay, if everything is good in the world, you can afford it. But what would happen if interest rates went up? What would happen if, like with the pandemic, you get put on furlough? Like, can you actually afford to do all of this over the longer term? So the bank's going to be assessing like how much money you have coming in versus how much money you have going out. The bank's going to ask you for things like your pay slips so that they can verify the amount of salary and income you have. They're also going to ask you for maybe like 3 to 6 months worth of bank statements so that they can see how you've been managing your money. They can see how much you have to spend. And they ask you for various other documentation, kind of prove your identity and things like that. And your mortgage broker will help you pull all of that together. But it's something that you should be thinking about at least 6 months before you apply for a mortgage, because you want to get your finances in shape to make you look as good as possible to a mortgage lender. And if you are kind of in that 6 to 12 months away from getting a mortgage, we have a brilliant action plan that you can follow that will help you get mortgage ready, so that when the time comes for you to actually put that application, you're looking great. Your credit score's in order, you've paid off any debts, and you look as good as you possibly can to a lender. So there's details of that in the show notes, and yeah, it's a brilliant plan, should be really helpful for you. So then when it comes to actually making the application, there's an application form that you fill in. And then, like we say, you have to provide all of this additional documentation that the bank will then go and do all of its affordability checks, all of the identification checks. So they go through a whole process on their side to make sure that you are who you say you are and that you can afford to take out this mortgage. They do checks on the property itself to make sure that it exists and that it's worth how much you're paying for it. So there's like a whole process for you to get that mortgage approval. Okay, we covered an awful lot in this video. I hope that it wasn't too much to take in. You can always rewatch parts if you need to go back over it. We have a ton more information on lifetise.com that will help you. Our membership plans walk you through all of the stages in the process, from saving your deposit through to getting your finances in shape before you apply for your mortgage, and then actually how do you get a mortgage and find a property and get those keys in your hand. So if that's of interest, then do sign up. We would love to have you as a member. Until next time, thanks for joining.